The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Larry Pesavento.
Okay, good afternoon, folks. Well, here we are going up in the new high ground again. Looks like while we're on the air, we might hit 17,000 in the Dow Jones. I actually entitled the newsletter this week Up, Up, and Away because we left a gap on Thursday following the news out of Europe, and, of course, we're up again on Friday. That means we've been up 15, 16 days now in the stock market without a serious correction, any correction, not even serious one. And the number of times that's happened in history, you could count on any of your 10 fingers, because in 200 years, it's just been a handful of times that that's actually occurred. This is how markets usually end, is with this spectacular type move. The problem is we have very little volume going on in the market now, but the market's still going up. The other thing that's troubling from a technical point of view is we're starting to see open interest dry up in the stock index futures. It's actually going down every day that the stock market goes up, and there's only one reason that can happen, and that is shorts are covering. As a short buys, he takes his position off, and that reduces the open interest, and so that's a very ominous sign. If you'll remember back when gold was at $1,932 per ounce, and we had silver at $49.50 per ounce, we were having the same phenomenon occur. And we were, telling folks that this is really a bad thing. And, of course, the market topped near that time. Now we're going to take a little trip down memory lane today. I posted a chart in here that was brought to my attention by one of the folks from the Tiger TV folks, one of the Tiger Den people, sent me a chart going back to the late 50s and where we are now. And what I'd like for you to do, if you get a chance to go in and look at this chart, because it is really a beautiful chart. It's showing this expanding triangle that we're looking at right now up at the 1950 area. This was actually chart was done back in November, 7 months ago, and so now what we're doing is we're just updating it. We're still near the highs. We're up at, we're making new highs, of course, at 1951. What I wanted to bring to your attention is not where we are now, but where we were back in the 1960s and 70s. If you'll notice, you'll see these three drive to a bottom pattern that was forming back from 1963. That 63 low, believe it or not, folks, that was the assassination of President Kennedy on November 22nd of 63. The market then rallied for 4 or 5 years right into the Vietnam War, and then as the Tet Offensive started, the market came down strong into 1970, and then as the war started to wind down a little bit, the market went up and made its third high, much like we're doing right here. But what's important is after that third high was made back in July of 1972, the market came down for 16 months and made a new low, and then it started the biggest bull move ever. That was 40 years ago. That was I was 15 years into my career at that time, hard to believe, but I remember that very, very vividly because that move down from 73 to 74 took all of my profits that I had made from 1963. It took 10 years of profits away in about 2 years. Most of it I gave back in an 8-week period during the September and October crash of 1974 by just doing really stupid things. And it took me a long time, well over a year, to understand, what I was doing wrong as far as money management and things like that. But the key to this chart here is it's doing an exact mirror image of what we're doing right now. Folks, we're looking at something really, really ominous getting ready to happen. Maybe I'm wrong, and I certainly hope I am, because I'm at the twilight of my 8 furlong race, so I'm not going to worry about it. And but I really see these charts as just being totally scary. It really is. I know it's hard to believe when you look at it that everything looks great, and we've had this $2 trillion pumped into the economy, and what amazes me, my little calculator won't do it, but if we put $2 trillion into the economy, we have 370 million people. I don't know how much that would be. Probably be between around $5,000 or $6,000, I guess, of every every amount of money. Excuse me, I guess it's closer to $4 trillion now. I don't remember exactly what it is. It was a lot of money. But they didn't give it to us, that much I'm sure of. But anyway, the market has gone up, but, the rest of the world has not really participated in it as much. The thing that I'm concerned about is that this chart is such a mirror image of what we had 40 years ago, and we will see how it ends. But markets that are doing what they are now, where they're gapping up like this and running for 8, 10, 12, 14 days in a row, these are how markets end, folks. These are not beginning moves. They're not. I mean, it could go another 30, 40 points higher, 50 points higher in the S&P, maybe 200 points higher in the Dow. But this is how markets end. They don't end with a little whimper, and say, oh, well, the top is finally in. They end very spectacular. This has been the biggest bull market that we've had in a very, very long time. And so I'm assuming that we will probably, make a top sometime. My guess is sometime around this week sometime, because we've got a full moon coming in on the 12th. The last, market bottom that we had was 14 days ago when we had the new moon, and we've been up every day since. And so my assumption is we'll probably go into either Tuesday or Wednesday, but we're in the zone. It could happen on Monday, but my guess is it'll go into Tuesday or Wednesday. So many of the patterns have completed ABCD patterns. They've gone beyond the D point, which is not unusual, because this is what happened when we were making our bottom in 2009. Remember, we finally stretched out to make the 61% retracement of the 1982 low in the stock market when the Dow was down around 600. We finally made that 61% retracement down at 666 in the S&P. Everybody was talking about it as the devil's number, but the devil be damned, and that was the bottom of the market on March the 5th of 2000. But these patterns are completing. We're in the last part of the range. When we gapped up on Thursday, that was the sign that we were probably going to have a nice little run here. And what we need to do now is, once we go below the lows we made on last Thursday, then that would tell us that we're probably in an area where we're going to have a pretty good correction, if not the major top. But this long-term stuff, boy, it's really scary. What's so really unusual about it is I've got a lot of friends in this business. Many of them are my age. A few of them are a little bit older than me. And they see the same thing that I'm doing, but they don't understand, because the volume that we're looking at here is so pathetic that it's just really, really scary. Now, what I'd like to do is I want to share another chart that was brought to my attention by also one of our folks from Tiger TV, and it's a great chart because it's the S&P going back 20 years, and it shows the volume of the things that are happening. It has a few timing things in it, and it looks very interesting, but it shows the expanding triangle that we've been watching, this 1, 2, 3, 4, 5 expanding triangle, also known as a reverse point wave, and that is also completing up in this area right here. But all during this move over the past several years, we're seeing decreases in volume, which is really quite pathetic. And I was really quite surprised to see that the stock index futures have been losing players. I mean, the open interest has been dropping. You would think that it would be expanding rapidly with a lot of players coming in with the market going up, and in fact, that's not what's happening, which means there's a lot of people that haven't participated in this last part of the move. We'll have to see how the ballpark ends up on this, but that's what it's looking like from a technical point of view. I really believe the fact that we've had this run here and the gap up on Thursday meant a great deal to tell us that that was the what I think is the final run to see what's going to happen to the move from that level. But we'll have to let history tell us if that is going to be the case. The question arises about the gold market. I heard Basil Chapman talking about the gold. Basil's looking for lower prices. I believe that he's correct, and I'm looking for lower prices also. It would take a move above $1,290 an ounce for me to change my mind, because there's too many targets that are down there at the $1,226 per ounce level in gold that would tell us that we would be really at a real serious place to look at it. That happens to be the 786 retracement of the move from 1170 up to 1395 and then back to 1226. That's 78.6%, and that would tell us that we're looking at that level. The other thing that deserves our attention is Michael Lewis, the fellow who wrote the book, The Big Short, and is now a big advocate of fighting against these high-frequency traders, has now filed a lawsuit against the 13 major brokerage firms, saying that they have preference to the high-frequency traders. And I want to wish Michael all the luck in the world on that one, because, boy, he's really got an uphill battle on his hands. I hope he asks for some donations, because it could probably take all of his money just to fight the courts on this stuff, but we'll have to wait and see how that occurs. I still don't understand the high-frequency trading stuff. I know what they're doing, and I see the volume and stuff like that, but I just don't understand where it would possibly affect what we do with pattern recognitions and the things that I see. Nothing has really changed. I mean, there's been some wonderful opportunities on these markets over the past 3 or 4 years when high-frequency trading really got into vogue. I mean, we've had, some good moves down. We've had some good moves up in the stock market, but look at the other markets that we've had. We've had, crude oil and treasury bonds and the foreign currencies and the grains. All of them have been, really great. I know they don't do high-frequency trading in those, but even the stocks that you look at have been acting, just technically perfect. Apple, for instance, hit a 786 retracement up here today after a 7-to-1 split, and the whole world is wanting to buy it today. And I'm sure they're going to give him the opportunity to do that, but we'll have to see what it's doing. It's had a heck of a run here since it made its low down around 385 last year and a half ago, and this is a heck of a run. So this is what you really want. Nobody wanted it at 385. Everybody wants it at 655. So whether they will make money on that, remains to be seen. But this is part of what we do in trading, is to determine what our probabilities are on the trades that we're looking at. But I really recommend that if you get a chance is to check these two charts that I posted into Tiger TV. One is the S&P cash going back to 1994, and it shows the difference in the bull markets, and this is by far the best one we've had in quite a few years, and it's done it on very, very declining volume, which in itself is really an amazing thing. Usually the volume is quite a bit better when you're running into stuff like this. I mean, it's just really amazing that there's been few participants, given the fact that you'd think the volume would be really rushing into this, and in fact it really isn't. Maybe there's going to be a spectacular blow-off, maybe, and that's a certain possibility, certainly a possibility, because I talked about that in the letter. Anytime you get a market that's gone more than 8 days in a row, you're in an outlier event that it can go anywhere. And I don't know if you remember, but the two biggest records in the commodity business are silver and sugar. Both of those went 22 days in a row up. Silver had an ominous part because it went 22 days. The last 11 were limit, and the next 18 were limit down. So it went 22 days up and 22 days down back in February of 1980. So those are the things that we're watching here in the market at this particular time. Okay, we're going to take a little break here. The Dow Jones is still up.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Wouldn't it be great if you could get a red light, green light indicator that gives you signals on 25 different future contracts? Now you can with Taz Signal Box. This red light, green light market profile system dynamically updates 24 hours a day and provides you with important trend and trade signals on 9 different commodities, 9 different indices, and 8 different currencies. Right now, you can receive a free 2-week trial to Taz Signal Box. For all the details and to find out how the signal box works, visit the front page of TFNN.com.
Andy Heck's powerful weekly newsletter, the Technomental Commodity Report, has delivered multiple triple-digit winning trades in recent months. And right now's the perfect time to get a full month-long trial to Andy's newsletter with no obligation to pay anything. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you'll lock in the low rate of only $59 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, folks, we're going to take a look at the German DAX. That's the equivalent to the S&P 500. There is a banking holiday in Germany today, so the market is very, very quiet. It's just like the overnight markets that we have here. There's very little volume going on. But the main thing is, if you look at the long-term chart that I have here going back well over 20 years, you'll see that it's also completing that same type of ABCD pattern that we're having with the expansions up at the 1.27 level. So that's the fourth largest economy in the world, making the same type of pattern. Now, these patterns, like they did in 2007 and also in 2000, because they're so large, can take weeks or even months to complete. So this one has gone much farther than I thought it was going to, but that doesn't surprise me because I'm wrong a lot. I'm right once in a while, but I'm wrong sometimes. But I try to recognize, when I'm wrong. What I'm watching for now is potential for a good low-risk entry sometime either Tuesday or Wednesday in the market, and that's what I would be looking to do somewhere around the 1952 to 1958 level in the S&P 500 futures. That's what I'm watching. Now we're getting ready to roll over from the June to the September, so there'll be a little change in price on that, but that's what we're watching. Now, I've had a request to take a look at the chart of General Electric. This used to be the most widely held stock in the world. I believe that Apple took the place of this about a year or so, maybe 2 years ago. But as you can see, the last 3 days in General Electric, we've had a 1-point move in the stock that's taken us up to the 786 level up here around the $27.50 per level per share level. Now remember, on a long-term basis, this stock used to be a really, really high-priced stock. And if you go back and look to see where we are from a long-term perspective, from where we back in 2007 when it was $43 per share, you'll take a look that the high that we made just a few weeks ago was exactly at a 61% retracement from the high of 2007, from the low down to 2009, which was on March the 5th. And that 61% retracement came in at 28, and we're trading at 27.50 right now. So we're retesting that 61% retracement of that whole move down in General Electric. That in itself would be a sign that I would be willing to, let some of my General Electric shares go if I bought them a few weeks or a few months ago, because it's going to have some pretty stiff resistance at this level, given what I'm seeing right here. However, we could get, like I mentioned before, and I mentioned it in the newsletter this week, there is a possibility that we could have a blow-off top of spectacular proportions, because we're seeing short covering in the stock indices. There's no new buyers coming in. If the shorts really panic, if the Dow gets above 17,000 with a lot of gusto, this could make the market move even faster. But what goes up does come down eventually, and maybe not in my lifetime, but eventually, and we'll see if that is going to occur. But this is a key week. Basil talked about this on his show, and I agree with some of the things that he's talking about. In particular, he was looking at the VIX index, in the fact that the VIX index was actually up a bit today, given the fact that the rest of the market was, really quite strong. So that would usually tell us that, that maybe a little bit of fear, or maybe just a little bit of protection is coming in to help folks to tell us that maybe this is not the place to get too bearish at this point, because the VIX index gapped down, as you well know, on Friday, and with the market up today, the VIX index is actually holding above the lows that we made last Friday, and whether that's going to be a good thing or not, we'll have to wait and see. The overall, someone asked a question about the open interest. Open interest, folks, is the number of buyers and sellers that come into the commodity markets. For every buyer, there has to be a seller, and that puts out the contract, because these are contracts that you have. When contracts are dropping in price, it means that people are leaving the business. So if the prices are going up and the open interest is dropping, that tells you that it's short covering, and it's just the opposite when it's going down. So you need a lot of buyers to keep the market going, because once the shorts cover, there are no other buyers there, and there's a vacuum under the market. We saw this in the gold and silver during the highs it was making at 1932 in gold and 49.50 in the silver. We were screaming about that at the time, the fact that open interest was dropping and dropping and dropping, yet the market was going ballistic. But as soon as it was over, that was it. There were no more buyers left. You saw what happened. The vacuum hit the market, and boom, down it went. My guess is the same thing will probably happen to our stock market, but whether it happens in my lifetime or not, we'll have to wait and see. But we're getting close. We're starting to see certain signs. Those gaps up that we had on Thursday, that's pretty much what we're looking at. Take a little break here, folks. The Dow's still up on the day. We've got gold still up on the day.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 9 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, we're back, folks, and I posted the chart into Tiger TV. It shows the cash S&P index, and it shows the gap that we had on Thursday. And so that's we're looking at some type of, we'll be filling that gap relatively soon. We got a call from Brent in California. Brent, can I help you?
Sure, Larry. How are you doing today?
I'm good, thank you. What can I do for you, my friend?
I was calling about the IBB. I was hoping to go over some numbers with you and just kind of double-check.
It looks to me like we're setting at the moment of truth at the 61% retracement here at 249.60. This is, if you wanted to get short, this is a spot where I would certainly do it because it's making a beautiful 61% retracement of the move that we made from the high to the low down at the 786 level. So 249.70 I think is the exact number, and we're trading at 249.64 right now.
Yeah, it looked like it was right there today. So.
Yes, it certainly is. And the other thing is the IWM is doing exactly the same thing. It's also making a retracement too. So. Whether they can go through these very easily, of course, but we're at that level right now. So whether it's going to continue that way, we'll have to just to see how it closes today. But if it closes below that 249 level, I think that you could put your stop just a little above today's high. And if it's right, it's going to make a lot of money. If it's wrong, it's going to lose a very, very small amount.
How much wiggle room do you give yourself? Obviously,
on a 300 on a stock like this that's trading at $249. I usually give 3%, which is $7 a share. But because it's an ETF, I don't know if you really need that much at all. As you notice, when it made its bottom down there, it made the 786 within $1. So I don't trade these ETFs. I just follow them because, other people look at them in the market. But they hit the numbers so uncannily perfect sometimes that I would say somewhere between $3.50 a share and $7 a share, because you're talking about something that's $249, so 3% of that is not very much.
It's actually a pretty good-looking chart, I thought.
Oh, boy, it's a perfect Gartley. That's Mother God and country, let me tell you. That's widows and orphans time.
All right, thank you very much, Larry. Have a great day. I'll talk to you soon.
You bet.
All right.
You bet. Now, the next chart that I wanted to talk about is truly an amazing chart to me, folks, because when I did the newsletter, I had to actually reread a couple of sentences more than once, and that was the fact that you're not going to believe this, but do you know that it is easier for Ireland to raise money than it is the United States Treasury? Ireland is one of the pigs, the PIGS countries. So Portugal, Portugal, Ireland, Italy, Spain, and Greece. And here we are. We're paying more to borrow money for the U.S. Treasury than they are from Ireland. And Spain is not much farther behind. And Italy, now that they're going to bring in the income tax on income from the La Cosa Nostra, if that exists or not, organized crime, i.e. the mafia, that's going to increase the GDP quite a bit in Italy. So that'll probably give someone here in the United States the idea that maybe we should also tax the, people that are in the organized crime business, whether it's, Colombians or whatever they are. I frankly don't know who they are or get involved with it very much at all. Living in Arizona, we have the Border Patrol, right by our house all the time. And believe me, they watch the folks coming in from Nogales because they can pack a mule in Arizona, in Mexico, bring it across the border, across the Sonoran Desert in the middle of the night, and they have enough on that mule to feed, I think, 27 families for a whole year. That's how much marijuana they're bringing across. I've heard that report several times, and so it's a big business. Unfortunately, that's pretty tough. But this Treasury note chart is telling us that we're below the 61% retracement today, and rates are starting to move higher. You'll notice that we left a big gap up here right after the 19th of May, and that's telling us that we've completed that large ABCD pattern in both notes and bonds, and that gives us the inclination that we are probably going to go higher in interest rates here. But the fact that we have to pay more than Ireland for our debt is something's not right here, folks. The ball is not bouncing in the right direction. We have a lot of problems, but boy, it's nothing like what they have in Ireland. It was just amazing. It was just a few short months ago they couldn't even borrow money. Now they can borrow it cheaper than we can. I don't know what's going on, but it's certainly something that is going to be rectified by the markets, would be my guess. I have one other question that someone asked me about, was the banking index stocks. They've held up relatively good on this down move. They stopped right where they should have. I'm going to post it into the room because it's a pretty good chart, and we are also setting exactly at the 61% retracement here in the banking stocks index, the BKX. And as you can see, we made the big 1, 2, 3, 4, 5 expanding triangle that we're making in stocks. And it's really an interesting chart because right here at 70.82 on this ETF, it is right at the 61% retracement also. And if you'll notice on this banking stock, it also really highlights the run that we've had since early May. This has been in a 16-day run. It hasn't had a correction in 16 days in the banking index, and now we're bouncing up against the 61% retracement up in here. So this market is very, very overbought under any stretch of anyone's imagination. The question is, how much higher is it going to go, and if it does turn, when is it going to turn? So I know it will turn because nothing goes up forever. The one thing we know for sure is that Isaac Newton's second law, what goes up must come, no, it's the first law, what goes up must come down, would tell us that that will happen someday. We haven't seen any of them that have done it yet. There have been a few that have tried, but most of them have turned to the downside. We have a situation now in the crude oil market because we are very, very close to that breakout. Give me 1 second here because I wanted to bring this up because this is a really important chart because we are up against these old highs one more time in crude oil, up at this 105 level. And if we bust through there, we could be trading it between 108 and 113 without any trouble at all. And we're having a really strong day today in crude, and that's telling us that the market most probably wants to, go a little bit higher. That would be my guess because of the strength that we're having today, crude being up over $1 and change, which is a pretty good move in that, and it's moving towards the 105 level really quickly. We're only 84 cents away in the crude oil from that. On the long-term basis on the crude, we have been in this really, really tight triangle for a long time, and it looks like the bias is going to be to try to take it to the upside, but whether it does that or not, we will have to just see if history is going to tell us or not. I have a request to revisit the chart of a price line because we talked about that in last week's report. One of our callers was involved on the short side of that, and it's amazing because with the rest of the market being incredibly strong, price line has been down for the last 8 days. So here's an example of a stock that is underperforming the market by a great deal. It went right up to the 61% retracement and is very close to taking out the lows that we made just on Friday at 1234. So if we take that out, that would give a price objective down around the 1180 level. Whenever you have a stock that is much weaker than the market, you have to think about that because if the market does weaken, this stock most probably will go down a lot faster than the rest of the market. That's an old, adage principle. We want to buy the strongest and sell the weakest, and this is the weakest, so that's something that I would have to be watching from a point of view of a potential, move to the downside. That's the basic of what we're looking at. One other question that someone brought to my attention, asked me about was the VIX index, the fact that, we had the gap down last Thursday and then again on Friday. Today the market has not followed through to the downside as yet. However, we have a situation where we could, very easily go down one more time in the VIX index. However, what I'm looking at in the VIX index, trading at around 11 right now, I'm looking for a move in that somewhere between 22 and 30 is what I'm looking for because this is a very good indicator of what's happening in the market, folks. We've got record margin debt like we've never had before. We've got high bullish consensus. It's just a matter of time. The Grim Reaper's out there. He's got his sickle. He's sharp putting it up. So, I know you're in there, and if you're in there swinging, great. But keep your stops in. Protect yourself. This market has been different, and it'll probably be different on the downside just like it was different on the upside. So just be careful. That's the bottom line of what I think you really need to do. So that's just my warning. Of course, I've built so many houses of straw and clay and brick, and all of them have been blown down. But, I still see some real ominous signs out there on these long-term patterns. Thankfully, I haven't been foolish enough to stay short for 16 days as the market goes up because I take little nibbles at it. Sometimes the nibbles work, sometimes they don't. But when you catch the first big downdraft that occurs, it's worth the price of trying to, enter the market with a real small amount of risk. And I don't put the stops too close, but usually around 5 points when I'm trading, the S&P. That's pretty much what I'm looking at. The stops that I use in other markets, have one of our listeners have asked me to talk about that a little bit. Basically, I've done so many trades over the past 50-some years that I know that in the ballpark of between $300 and $800 gives me enough risk to enter just about any market that I want to do. The upper end of that range, the $800 range, is basically crude oil and gold. Those are the ones that I risk as much as $800. That's 80 pips in the crude oil, and it's $8 in gold. That gives you plenty of leeway to get through in the foreign currency markets. I'm usually only risking between 30 and 50 pips. That's usually between $300 and $500 because the numbers and patterns that we look at fit so nicely within these numbers that you don't really have to risk any more than that, when you're looking at those things. Folks, this trading is not about being right or wrong. It's about making money. And part of making money is not losing money. So when you're not trading because you don't see anything, that is actually a good position. No position is a good position because you're not seeing something that, gives you the advantage, and that's what you really have to do. So if you don't see anything, don't trade just for trading purposes. Trade because you're looking at something to tell you that it's giving you a chance to get in at a very, very low risk, and that's what you're trying to do in trading. It's a business of making money, not being right or wrong. And keep that in mind. It's a very important fact to keep in mind. I have my best friend, the best man at my wedding was Mark Douglas, and every time we meet, he always gets on his little soapbox and talks about the business of making money and not being right or wrong. And he talks to me because I write a newsletter, and people ask me because I'm supposed to know more than some people, a lot less than others. But I have an opinion, and usually with my opinion, I bring a caveat that, look, if it gets above this point or below this point, I'm totally wrong because, I'm not going to sit there watch the market go up for 16 days and, have your money invested. You might try 1 or 2 days, but not 15 or 16. And we watch the price levels very, very closely, and that's the real key to what we're watching right now. Stocks are still inching up a little bit higher here. They have given back some of their gains, but they're still up on the day. Gold has given back some of its, but it's still holding up relatively well, and the rest of the market seems to be doing pretty good. This is a question that I've never gotten before. They ask about a contract in water, and I don't know if they have that. I imagine they will someday, but they don't have any contracts in water right now. I just don't see that. I haven't heard about it, but because there's a lot of interest in water. And by the way, the capital of water is Brazil. Let me tell you, they've got the best water in the world, supposedly the best fresh water supply in the world. So we'll wait and see that. I have a question about December corn. December corn looked like it was going to be pretty good, and then it broke. We've had a little bit of a rally because of some weather problems. We've got the grain stocks report coming out very soon here. I believe Tuesday or Wednesday this week. See, the 11th or 12th. That'll be the 12th. I think 11th or 12th will be the grain report. That'll have some effect, but it's the middle of the starting of the growing season, so it's mainly a weather-related market. And we'll get some pretty bad weather scares. But right now, I don't see anything to do in the December corn because we went through the 61% retracement and the 786. So we have to just wait to see if it's going to hold, that $4.40 per bushel level down at the double bottom in December corn. If we get to that level, but that's still a little farther away, and we'll have to take a look at that. When we get back from our next little break here, I'll put the corn chart up, and we can take a look at it, and we'll see if it'll give us a little spot here. But we have a little bit of a bounce due to some of the weather problems we've been having, and boy, they've been everywhere, that's for sure. And we always have at least 1 or 2 scares, sometimes more. And we just started the corn. Corn is supposed to be as high as an elephant's high by the 4th of July, and it's not going to be anywhere near that this year. So we'll have to wait and see if it catches up or we're going to do it. We're going to take a little break here with the Dow still up on the day, and NASDAQ is still.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
Up next, the Diagnostics Trading Hour with Daryl Martin here on TFNN.
Okay, we're back, folks, and one of the things I wanted to mention, our good friend Steve Rhodes brought it to my attention again. I had it on the list to cover, but I haven't, and that is that Mercury has gone retrograde today, going retrograde, and that usually means decisions that you make will be probably compromised. You're not supposed to sign any contracts or buy anything of any significance during the time that Mercury's retrograde, but we'll have to wait and see. I've had 2 requests. One is for December corn. I posted that chart into Tiger TV, and it shows the retracement that we were looking at. We tried the farming business there for 10 cents. It didn't work, and now the market is below the 786. I can't look at it again until we at least get down to that double bottom, or we do some types of a consolidation here under the 786 level, and then take a look at it. We had the same thing happen in the wheat market. We had a big break and then a slight rally and then another pullback. The last chart that I wanted to talk about was going to look at the euro. This is the largest thing that's ever traded, folks. It's hundreds and hundreds, and if not thousands of times bigger than the stock markets. And as you can see, we went down below that 135.70 level. Keep an eye on the price of 135.40. If we close below 135.40 in the euro, I believe we're going to be looking at you're going to be knocking at the devil's door, and you know where that is. because it could really head to the downside. So the key price, I believe, is 135.40. That means it would give more than 78% of this last rally that we had from the 135.10 level up to the 136.80, which was another, it was the first 2-day rally we've had, and it was very fast, and now we're giving back most of it. It's coming down to the 61% retracement of that right now. So whether that's going to hold, we'll have to wait and see. But the key price in the euro from the technical perspective using pattern recognition is the 135.30, 135.40 level, because that tells us that we would be setting up another move below 134. And believe me, folks, below 133, there is a lot of air in the price of the euro. I wanted to put the weekly in there, and you'll see that this market could go a long way because it's had lower tops for a long time, and we've had very little rallies over the past 8 or 9 weeks, which is very ominous of more price movement to the downside. So a price level of at least 127 in the euro could happen very quickly, much like it did during 2011 and 2012. So once this market starts down, it doesn't take any prisoners, much like the S&P on the upside. It didn't take any prisoners. It taught the shorts, a really nasty lesson, but in fact, the euro can do the same thing on the downside because of the fact that it has such a bearish long-term pattern and it has a very bearish short-term pattern both. So that's telling you that the bias is certainly to the downside, looking at this. That's the way that it looks like. We have the same thing occurring pretty much in the Swiss franc and some of the other things that we do. The junk bond chart looks the same as it did 2 or 3 weeks ago. There's no fear in the market at all, folks. We can tell that from the VIX index, the high-grade bonds, which are junk bonds, JKN, and also the JNK, and also the HYG. They all look exactly alike. They've been overbought. They still go higher because people are wanting yield. I mean, hey, folks, when Ireland can borrow money cheaper than we can, shut the front door and raise the rent. Something's wrong, folks. Use a little common sense. Why are they letting Ireland borrow money cheaper than the United States? These are not nickel and dime. This is not mom and pop. This is major stuff. These are the big hedge fund boys and the big, Fidelity and all the others, whatever they are. But that's what that is. I mean, this is major stuff. Those are countries that are doing that. So something's not right. This is not right when our country has to pay more. Live every day in an attitude of gratitude and may God bless.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
You're watching Tiger TV.